What is the journal entry for software amortization? Have you ever wondered how businesses account for the cost of software over time? It's an important concept in accounting known as software amortization. Let's break it down together. Software amortization is the method used to spread the cost of a software asset over its useful life. This process helps businesses reflect the value consumed from the software in their financial records. When a company purchases software, it is recorded as an intangible asset on the balance sheet. This means that the cost of the software is capitalized. Over time, as the software is used, its cost is gradually expensed through amortization. This expense appears on the income statement, while accumulated amortization is shown as a contra-asset account on the balance sheet. This account reduces the carrying amount of the software asset. So, what does the actual journal entry look like for software amortization? Each time a company recognizes the amortization expense, it will debit the amortization expense account. This entry reflects the expense for that accounting period. At the same time, the company will credit the accumulated amortization account. This credit accumulates the total amount of amortization taken to date. Let's consider a practical example. Suppose a company capitalizes software that costs $10,000. If the software has an expected useful life of 5 years, the annual amortization expense would be $2,000. This is calculated by dividing the total cost by the number of years. The journal entry for this annual amortization would be straightforward. The company would debit the amortization expense account for $2,000. Simultaneously, it would credit the accumulated amortization account for the same amount. This entry is repeated each accounting period until the software is fully amortized or disposed of. To summarize the journal entry format, you would have the amortization expense account debited and the accumulated amortization account credited, both for the same amount. This method does not affect cash flow since it is a non-cash expense. It simply reflects the allocation of the software asset's cost over time. In practical terms, recognizing this amortization expense reduces the reported net income of the company. It also decreases the net book value of the software asset on the balance sheet. This accounting treatment aligns with the matching principle, ensuring that expenses are matched with the periods that benefit from the software. In tax accounting, there may be specific rules regarding software amortization depending on the jurisdiction. However, the fundamental journal entry remains consistent with the principles we discussed. Understanding these entries is essential for anyone learning the basics of accounting and how debits and credits work in practice.